Hey traders, Jason here from Leavitt Brothers. In this video, I'm going to do an update of my State of the Market series. I'll cover the indexes, then I'll look at breadth, the 80 line, 80 volume line, some high-low numbers, and stocks above moving averages. All right, so let's get to it. Let's get a general idea of what's going on in the market based on this stuff, and then I'll close out with some final comments. All right, so here is the S&P 500 weekly. Obviously, super strong trend. Moved off the low last March, traded sideways last fall, and has been trending up ever since. You see the 21's been good support, the 8's been support at times, and 3 weeks ago it made a new all-time high. Last week it made a new all-time high. This week it made a new all-time high. Volume is fine. Nothing wrong with this chart. This is a super strong trend. You can't be anything but bullish per this chart. Okay. Now let's look. Here's the Nasdaq. It is equally strong. Moved off the March low, paused for a few months last September, October, rallied out of that, paused for most of this year, and then 3 weeks ago it broke out to a new high, added to the gains last week, and this week it's following through a little bit. Not too much, just a little bit. So again, this is a super strong index, trending up, nothing wrong. Generally finding support at the 21-week moving average. Everything looks great here. Here is the S&P 600 small caps. A little bit different story. Trended up off the March low, trended sideways for 4 or 5 months, broke out and went on a huge run last November, December, January into February, and then even into the beginning of March. But the index has been basically flat since then, so we're flat over the last 4 months. And obviously there's a little bit of a divergence forming between this chart and the Nasdaq and the S&P 500. And because this is a weekly chart, when you have a divergence over the course of 3 or 4 or 5 candles, that's like a month or longer. So with the Nas and the S&P, they're pressing higher week after week after week, making new highs. And obviously right here, we've made 2 consecutive lower highs. Okay, so divergence is forming. The market is being pulled higher by the large cap stocks because some of the small caps are just simply not participating. Besides the fact that it's down the last 2 weeks, going back 4 months, it's pretty much unchanged. All right, so it's something to keep in mind that the small caps are not completely participating in the gains. All right, now let's look at breadth. All right, I'm going to not zip through these, but go through them. All right, so here's SP 500 up top, and what we have here is we have the 10-day, 50-day, and 200-day moving averages of the NYSE 80 line. Okay, characteristic of an uptrend is like you're going to have the 10-day 80 line just kind of rolling up and down, mostly above zero. Okay, but prints a little bit below zero are fine. But as long as you get these rolling prints mostly above zero, that supports an uptrend. That's exactly what we're getting. I don't see any major issues here. We could start to see like maybe a divergence here forming. Okay, it's the beginning, but I find that divergences that occur at higher levels are less meaningful than, let's say, a divergence that forms at a lower level, which is what we got here, with a higher high here and a lower high here, where the second where the second hump was down near zero or even below zero. Okay, this over here is pretty powerful. There's lots of negative pressure building, but when you get a divergence at a higher level, it's less potent. Okay, with the 50-day moving average, stocks are, the indicator is just rolling up and down at an elevated level. Okay, this fully supports the trend. Again, you have a divergence here, not a huge issue. It's the kind of thing that could lead to a short-term pullback, but nothing really bigger than that. And then with the 200-day moving average of the 80 line looks great also. All right, now let's look at, this is the Nasdaq. This is the Nasdaq up top versus the 10-day. This is going to be the 10-day, 20-day, and 50-day moving averages of the Nasdaq 80 volume line. Okay, so the 80 line lets all stocks count equally. It doesn't matter if you're Apple or some small cap stock, they count equally. With this indicator, it deals with volume. So the higher volume stocks have more influence. Now, it's not perfect because you have a stock like Amazon, which is gigantic, but because it's so expensive, it doesn't trade as much volume as maybe a smaller cap stock that doesn't deserve to have the same influence. So it's not perfect, but it's still good to look at. Okay, the analysis is still very much the same, and in this case, there's a little bit of a, I don't want to say a bleak picture, but it's not as rosy as with the AD line at the NYSE. So you have higher highs here with the Nasdaq. You got a very obvious divergence here. Okay, and then you have a very obvious divergence here with the 20-day, and the 50-day just lost zero and is now below zero. Okay, so as the market has moved up over the last month, 4 or 5 weeks, the 10-day and the 20-day moving averages of the AD volume line have been declining. Okay, so declining volume has been outpacing advancing volume, and you can see here, like, with the 20, it's below zero. I mean, in all cases, it's below zero. So it's something to watch out for. It's something to keep in mind. Okay, as the market's moving up, we have like negative pressures building because declining volume is greater than advancing volume. Like I said, it's not a perfect indicator because you have sometimes bigger stocks or expensive stocks that don't trade as much volume as smaller companies, but it's still a pretty good guide. It's not something you want to ignore. Just as an example, you had higher highs here, but you had lower highs here, and in this case it'd be declining. So you get like prints down here under zero at a time when we're making new highs here. It's not does it mean the market's going to crash? Not necessarily, but it's certainly something to be mindful of, and you definitely want to be more cautious trading wise. All right, so we have S&P 500 up top. We have new highs. We have NYSE new highs and Nasdaq new highs. Okay, we just want support. If the market's making new highs, we should have new highs among individual stocks. If there's a lack of new highs, that kind of tells you that breadth is starting to decline a little bit. It's a little bit of a divergence, not a big deal, but if it's a bigger divergence that lasts a while, it builds internal negative pressure. This is what's happening right now. So we have the market's been moving up and up and up. Other than a couple down days over here a couple weeks ago, the market's been very slowly grinding up for about 6-7 weeks. But while this is taking place, the number of NYSE stocks making a new high has been declining, and the number of Nasdaq stocks that have been making new highs has been declining. And in both cases, the prints are relatively low. Now, we don't need constant high prints. Okay, we just need, like this to me is perfect. Okay, just having new highs just kind of jump around like this at a pretty good level is perfectly fine. But when it's pretty obvious that over the course of a couple weeks there's less and less stocks making a new high, that builds negative pressure internally, and it's only a matter of time where either this indicator jumps up or the market is going to get pulled down. It's only a matter of time. This can't persist like week after week after week. Taking a step further, this is the large cap new highs, mid cap new highs, small cap new highs. So of the S&P 500, so we have divergences in all cases. Okay, so in all cases, as the market has gone higher over here, the number of new highs in all market caps has declined. Now with the large caps, it's not too bad. Okay, this is like close enough that it's not a big deal. The S&P 500 has a little bit more than 500 stocks, and right over here you have about 54 stocks that are at new highs. That's about 10%, a little bit more than 10%. But with the mid caps, you have 400 stocks in the S&P 400 mid caps, but only 9 stocks are at a new high, and you have 600 S&P 600 small cap stocks in the index, and only 6 stocks are making a new high. Okay, so over here it's like 54, and over here it's 6. Okay, so a lot of the weakness is concentrated in the small caps. Not a big surprise. You saw what the S&P 500 chart looked like at the beginning. You also saw what the small cap chart looked like at the beginning. So we can see the weakness is mostly in the small caps. They're not participating. There's not a lot of it's not just a question of like the AD line is weak. It's like you have very few stocks within the small caps that are making a new high. There are very few stocks that are matching this movement. Okay, so this builds internal negative pressure. So here, what we have is this is the blue line up here is the S&P 500, and this not tick data, but these data points are the Russell 3000 number of Russell 3000 stocks at a 1 month high low. Okay, so we just did new highs with the NYSE and the Nasdaq. We did new highs among the large caps, mid caps, and small caps. So this is going to be like high low. So it's how many stocks, and this is going to be the 1 month high low. So instead of just looking at 52-week high lows, which is sometimes a high bar to cross, now we're going to look at 1 month high lows. So you only have to be better than you were a month ago, or at any point in time over the last month. So two things I want to point out. Number one is that we do have a divergence in place. Okay, so we have higher highs here for the S&P, lower highs here for the number of Russell 3000 stocks at a 1 month high low. Okay, so that's the number one kind of thing that kind of jumps out here. You can see this played out over here where you got less and less stocks. As the market was moving up, you got less and less stocks, and it induced a little bit of a pullback here. Okay, number two I want to look at is just the absolute number. Is that we have the absolute number here is negative 342, which means even though the S&P 500 is up here at a new high, you have 342 more stocks making a new 1 month low versus a 1 month high. Okay, so that's not an ideal situation. And then the last thing I want to point out is the lack of prints above 500 here. Okay, you can see there's a couple of them. Okay, characteristic of an uptrend. Okay, so if you look at this uptrend over here, characteristic of an uptrend is you have these random prints that are above 500, and you can see them all in here. Like randomly on certain days, certain weeks, you get these, really good. Market goes up a bunch, and you get a really high print, and that's a sign of strength. That's a sign of health. Okay, you want that. But here we have market continues up, but there's very few of these random prints above 500. Okay, so we got so this curve over here is almost like it's like a day-to-day print. Okay, it just kind of tells you what's going on overall. But this tells you that not even on a random good day could you get a good print. Okay, this is kind of like an average, not an average, but it operates kind of like an average. This just requires on one random day can we get a high print, and it happened very, very, very rarely. Okay, so a lot of reason to interpret this as breadth is deteriorating. Some internal negative pressure is building. All right, now we're going to move on to another indicator, SP 500 up top. We have SPX stocks above their 50-day or 20-day moving average, and SPX stocks above their 50-day moving average. And as you can see, it's been declining. Okay, percentage of S&P stocks above their 20-day moving average has generally trended down. And as I record this, the print is below 50%. So even though the S&P is up here at a new high, and it's printing a new high practically every day, you have less than half the stocks in the S&P are above their 20-day moving average. And with the relative to the 50-day moving average, which is a much easier bar to get over, you still have a declining indicator. It's above 50%, but certainly not what you'd expect. Okay, when you have when the S&P is here, and you have 80% of stocks above their, that's more like 85% of stocks are above their 50, and then the market dips and recovers, and it's at a new high there, but now only 75% of stocks are above their 50, and then it dips and recovers over to here, and now literally as I record this, we're talking 55% of stocks are above their 50-day moving average. Okay, so within the SP 500, less and less stocks are participating. So here's the Nasdaq up top, and what's below is the percentage of Nasdaq 100 stocks above their 50-day moving average. So the Nasdaq 100 are the largest, highest quality stocks within the Nasdaq. For a while, there was a divergence forming. Okay, and you can match this stuff up. That when the market was at new highs here, you had 80 to 85, 86, 87% of NDX stocks above their 50s. Market corrected and then rebounded and was at a new high here, and now you only had 60, 65% of stocks. But this now has been negated because just in the last couple of weeks, this thing shot up. Okay, so I don't look at this as a divergence, because when there's a big void space in between, I don't compare these prints to these prints. Okay, I'm willing to just look at the absolute number, and right now, Nasdaq at a new high, and over here we have 72% of stocks above their 50-day moving average. That's good enough. Okay, I'd like it to be higher, but that's good enough. Okay, but if we take this a step further, here is the Nasdaq, same chart above, But what's below is the Nasdaq stocks above their 50-day moving average. Okay, so the last one was the Nasdaq 100, so it's the 100 highest quality and biggest stocks. This one is just the Nasdaq, and you can see the picture is much is not as rosy. Okay, so you have the Nasdaq over here making a new high, and you only have 65% of stocks above their moving average. Then we make another new high over here, and it's like more like 61% of stocks above their moving average. And now we have another new high over here, and now we have 46% of stocks above their moving average. Okay, so if you and this includes the Nasdaq 100 stock. So if you look at the Nasdaq 100, you think market's doing fine. Lots of stocks participating, at least participation is good enough. But when you include every single stock in the Nasdaq, not even half the stocks are above their 50-day moving average. And the 50-day is not that high of a bar. Sometimes if you're looking at the 10 or 20-day, if a stock trades in a range and it sells off for a couple days in a row, it's going to lose one of those moving averages. But if the market's healthy, it's not that hard to be above a 50-day moving average. But as you can see here, there's a lot of internal pressure that's building that is not supportive of the market's trend. All right, last chart. This is going to be the S&P 500 up top, and what's below is going to be the Russell 3000 stocks above their 20-day moving average. Okay, so the last chart was the Nasdaq stocks above their 50s. This is the Russell 3000 above their 20s. The picture is very, very similar. You have an uptrending market. You have less and less stocks participating. If I were to draw a line, that's about the 50% mark. So, for a good 5 weeks or so, 6 weeks, we've had less than 50% of Russell 3000 stocks above their 20-day moving average. So this, market's pressing higher and higher and higher day after day after day. More up days than down days, et cetera, but yet less and less stocks are participating. So again, internal pressure building. Okay, so overall, the market looks iffy here. Okay, the indexes look good. The S&P and the Nasdaq look really good. Small caps are just kind of flat over the last couple months, but breadth continues to decline. This past weekend, I told Lever Brothers subscribers that there wasn't a single chart that jumped out and begged to be traded. There were some decent setups, but if I broke our trading list into an A list and a B list, there wasn't a single stock that would make the A list. Okay, the key to trading is to maximize opportunities. When the market is acting right, you got to push and make as much as you can. But when the market is iffy, you have to back off. Okay, overall, my bias is still to the long side, but near term, I continue to be cautious. I'm not taking any big chances right now. All right, thanks for watching, and I'll see you next time.